On behalf of Eastern Bank and Eastern Wealth Management, I just want to welcome you here this evening. Eastern Bank has a long history in the North Shore. In fact, Eastern Bank began right here in Salem in 1818 as the Institution for Savings. If you can see over the years, through a series of acquisitions, organic growth, and mergers, the bank has grown substantially. Still a small bank, but it's grown substantially from its origin. Today it's an $8 billion bank with branches, 99 branches stretching from Newburyport to Hyannis, headquartered in Boston. At Eastern Wealth Management, we manage about $1.6 billion. We have 3 locations. We're headquartered in Boston as well. We have an office in Norwell and another office in Saugus on Route 1. We're a team of 47 professionals with the experience and the credentials to help you achieve your goals. Just wanted to ask the account officers and those folks from the bank or from wealth management just to raise your hand. Just so you can look around, you see a number of the folks. Most of those are account officers. Most of those folks fall in these categories as far as the designations I've listed there as well. Each of our relationships begins with us assigning an account officer, one of those individuals you just mentioned, to your account. And from there, they work with you to understand your goals, your objectives, work to help you achieve your financial goals. The process begins with that. I want to walk away from the microphone, I can't. The process begins with that analysis. But from there, they work to integrate the disparate parts of your financial life and incorporate that to help you make your plans and make your goals. I'd like to introduce our featured speaker, Michael Tyler. Michael joined us 7 months ago, I guess it is, Michael, back last October. And just a little history there. We were changing the way we deliver our investment service. And I did an extensive search, and after talking to no fewer than 30 candidates, Michael was a standout as far as a candidate for this position. Prior to joining us, he ran his own hedge fund in San Francisco for 7 years. Before that, 16 years as a partner at Wellington Management here in Boston. Undergraduate degree from Princeton University, MBA from Harvard University, and he holds a CFA, a Certified Financial Analyst degree. What I think you'll find tonight in Michael's presentation, what I like so much about him, is he makes the complex simple. He has a way to add some levity to some situations that otherwise are very dry, and I think you'll enjoy the presentation. A little side story. Me and my boss and a number of others had each of the candidates, the finalists, give us a presentation. And without exaggeration, Michael walked in with a deck that must have been about, we call it a deck, a presentation about 52 pages. And I turned to my boss and we looked at each other and we thought we were going to pass out. But 52 pages later, the presentation was over and we enjoyed it. So that was really one of the reasons we hired Michael. And with that, I hope you have the same experience. With that, I just wanted to introduce the Chief Investment Officer, Michael Tyler. Michael?
What I'm going to do is talk about a bunch of things and try to do it in a way that, as Bill said, keeps it kind of light and reasonably enjoyable. And what I'll suggest, we've got copies of the slides. Most of you picked it up as you came in. We got pads of paper and stuff. Because we're doing this on video, I'm going to suggest that if you have some questions, write it down right away and then come back to it at the end, and I'll stick around for as long as you want to take some questions about pretty much anything that we talk about. What I am going to do is talk about a few things here. As we look at the investment world, at the economic world, what's going on and how do we get here? And then, frankly, is this different from any other time in our lives? And if it is different, do the same rules apply that used to apply, or are we needing to change the rules of investing, if you will, change the way that we think about our investments in order to be successful in what we're doing? And then I'll talk again at the end about, okay, given that set of rules, given the context that we're in, how do you put together an investment portfolio that works for you? So let's just start. Interest rates are low. You hear that on the TV news all the time. How low are they? The answer is a lot. This is a chart of the 10-year Treasury bill, 10-year Treasury note, and it shows you the percent interest on the left. Obviously, this was that big spike in the late 70s and early 80s. Well, right now, we are at the lowest point on this chart. The left edge of that, 1790, in the history of the United States, we have never been in a lower interest rate environment than right now. This is unique. And I'll go a step further. Take a look at this. Goldman Sachs, very smart people, did some work, and they found interest rates now are the lowest that they have been, based on a whole bunch of data they've done, since the year 1285 in Italy somewhere. I mean, the mathematics that went into that, I'm sure, are extraordinary. But the point is, we are dealing with interest rates at a 700-year low, and bond prices, as a result, at a 700-year high. This is a bit unusual right now. And I'm going to take it even a step further than that and talk about different kinds of interest rates and different kinds of bonds and notes and so on. What I'm showing you here is the difference in price, or the difference in yield, really, between different kinds of bonds. The green line is investment-grade corporate debt compared to treasuries, and the red line is high yield or junk bonds compared to treasuries. So what you see is that the higher those lines go, the more that higher risk investments are giving you a premium yield, better interest rate, versus a safe investment like a treasury. And again, what do you see? What you see is that right now, we're not really in record low territory. In other words, risk assets have been more expensive in the past relative to treasuries, but we're getting there. So a lot of the value that comes from going to other places has been already washed away. So yes, we are in a very different place. How did we get here? I'm going to go through this section reasonably quickly. It's mostly economic stuff, but I'll try to keep it lively. This is simply a chart of the gross domestic product, the total production of the United States over the last roughly dozen years or so. And what it's showing you is that it's been growing. I mean, if you can figure out, that's the 2008 recession. Since then, economic growth has been positive every quarter for now something like 15 straight quarters, going on more than 5 years almost. The green line, which is a little difficult to see, is our projection of where it's going for the rest of this year. It was up 2.5% as of the first quarter. That may be revised as they get better data. It's going to slip a little bit in the second quarter, mainly because Hurricane Sandy did such damage in the fourth quarter of last year that there was a lot of rebuilding that happened in the first quarter of this year. That's transitory. But as you look forward, we think that the rest of the year looks pretty good. What's fascinating to me is that when you think about the total economy of the United States, you have to break it down into constituent parts. And so here I'm showing you for the first quarter of this year what those constituent parts are. What you see, the top line, government, is in the red. So government, in effect, is in recession. Well, that's pretty obvious, right? Defense spending was down by the biggest amount in 40 years over the last 2 quarters. And certainly the sequester and the fiscal cliff and all that, all of those things reduced government spending. And so, in fact, government, as a creator of economic growth, is down. But look at the bottom section. Consumption and housing and inventory and investment, the things that the private sector does, that we all do for a living, that's growing, and in fact, it's growing quite well. It may not feel that way, certainly, and I'll talk about unemployment and some of those issues in a few minutes, but the fact is that the U.S. economy is doing reasonably well right now, especially in the private sector. You would think that if the economy is doing well, then maybe there's some pressure on cost, right? That there's more demand, and so maybe there's some supply pressure as a result, and prices might be going up, and we'd be having some inflation. There isn't inflation. Why? Well, one of the major inputs of any cost is energy, oil prices, gas prices, and so on. What I'm showing you here is the production of U.S. oil. And what you'll see is that in the last few years, it has grown tremendously in terms of almost by 35% over the last 3 or 4 years. That's everything you read in the paper about fracking and about North Dakota and Pennsylvania and all those new developments in oil production. It's really goosed up our production. It's taken us to the point where in a few years we will be a net oil exporter. We will be supplying other markets with oil. And in fact, on the right side, you'll see that the amount of oil that we have, the gray banded areas just show kind of over a 5-year range roughly how much oil is in stock through a seasonal 1 year. The red line is where we are today. We're swimming in oil. It's as simple as that. And when you're swimming in oil, there's no price. And so what you see, the Consumer Price Index, this is a measure of inflation. I've taken it back 30 years to 1981. There is no inflation. It's that simple. There are pockets, such as housing, where prices are going up. There are other areas, such as energy, where it's going down. But by and large, there's no inflation. And when there's no inflation and there is growth, that means that there is room for people to start making money as investors. Let's talk about one area that is changing, and it's changing in a very important and good way, and that's the housing market. Now, interest rates, we've already said, are very low. And in fact, on the left-hand side here, you can see these are mortgage rates for 30-year, 15-year, and 1-year ARMs over the past, again, 10 or so years. They've come straight down. So when I bought a house in 2008, I took a mortgage of 6 3/8%. And I'd say that was pretty common at the time. I refinanced it a few months ago for 3 1/8%. I've cut my mortgage almost in half. I would suggest to each of you that if you're paying 5 and 6% on a mortgage and you want to pay less, or if you want to shorten the number of years that you're paying, this is a very good time to do it. And I'm going to tell you one other reason in a moment. This is the inventory of homes for sale. In 2008, when we had a banking crisis, everybody wanted to get out. There were lots of homes on the market. There were a lot of foreclosures. Today, most of those foreclosures have been worked through the system. The ones that are left are in places nobody wants to live, and they'll be there forever and forget about it. But in places that people do live and work, like the Boston area, like most major metro areas, in fact, there's less and less for sale. So what happens when you have cheap money and you have low inventory is you get prices going up. And so housing prices have been rising. There's really no difference between the blue and red parts of that line. It's just how many cities are in the index. But what it's telling you is that housing prices have long since passed their bottom and they are rising. And this is important because if you bought a house or refinanced in 2008 or somewhere around there at, let's say, 80% loan to value and 20% equity, and then your house went down in value, you can't refinance, right? You have no equity in the house. But now, as prices are going up, you can refinance, and that's important. If your income is decent, then finally you are able to refinance your house with the same loan to value that you had before at a much lower rate. That's putting money in your pocket so that you can take that vacation, you can build on the extra room, you can remodel the kitchen, or you can invest it in the market. Whatever you're going to do with it, it's putting money to work much more productively, and that's good for the economy as well. And you're seeing that here. These are housing starts. Remember I showed you a minute ago that the number of houses on the market has come down. Well, in a natural capitalist economy, that's an incentive to build new houses. And that's what's happening. People are building new houses. And as they do, they're putting construction people to work again. Construction is the single biggest area of volatility in job growth. That certainly took it hardest when things went down in 2007 and 2008. And so we're finally seeing a recovery in construction jobs. That's really wonderful because that money gets recycled through the economy many times. And so look at this. On the left, I'm showing you the change in payrolls, just the number of people working. And you can see that since the beginning of 2009, that's March 2009, every single month more and more people are going to work. Payrolls are increasing. The economy is recovering. It is getting better. On the right side, the unemployment rate, that's a monthly rate, is drifting lower. It's not going lower fast. You would think with all these new jobs coming into the market, it would go down somewhat faster. It's not. And here's why. This is a phenomenon that I call hidden unemployment. When the government tracks unemployment, what they're looking at is how many people are getting a check each month from the State Unemployment Bureau. But after a certain number of months, you term out and you can't get any more benefits. As far as the government is concerned, you're no longer unemployed. You're now out of the labor force. Or if you are in a position where you're underemployed, you're not really part of the labor force, you're not doing as much as you can, that's again something that doesn't count as unemployment. But these are people who are active, they care, they want to get back to work, even if they're not counted as unemployed. And so what you see here is workforce participation. That is to say, what percentage of the working age population is actually working, the answer is it's been coming down for about 10 years, maybe even more. And as long as it's coming down, think about what that means when the economy starts getting better. It means some of these people are going back to work. They're coming back into the workforce. That's great for the economy because it means that they're earning money and they're going to be spending money and they're going to be creating more jobs. But it does mean that the unemployment number is a number that I think you should worry less about. And if it stays high, it's because of this, and it's not something that you should panic over. On the other hand, this chart, this is one of my favorite charts. I call it the spaghetti chart. What it's showing you is each of those lines is one economic downturn since World War II. We're looking at the number of months going across the chart and the percentage of jobs lost going down the chart. So you take any given recession. Let's take that one right there. This was a recession that was quite steep, down to around there, and then it started recovering. Typically, that's about, call it 2 years or so, from the time it starts going down until the time that you get back to the same number of jobs that were there before the recession began. So it's a way of kind of measuring how long is this taking to recover. Most of those recessions since World War II were about 2 years, and they weren't very steep. This one was the dot-com bust, and if you think about that, it affected technology but not much else, so it was fairly shallow, as you can see. This one, want to guess which one that is? That's the one we're in. And what you see is that 5 years later, we're still 2% below where we were. There are 3 million jobs that 5 years after the fact we haven't replaced yet. That is an area of concern. That's why, as the economy improves, we need to see more people getting back to work, whether they come from the quote-unquote unemployed or from the quote-unquote not part of the labor force. Frankly, it doesn't bother me either way, but we need to get more people back to work. So is this time really different? Well, you look at some of those charts and you say, yeah, I mean, interest rates are lower than they've ever been. The unemployment rate has taken a long time to recover. The growth since the bottom has been slow and sluggish. And what the Federal Reserve has done has been to recognize that it's very different than we've ever had before. In 2008, when we had a serious banking crisis, they responded with the tools that were available and that work on banks. They injected liquidity, they greased the machine, and it worked. It saved the banking system. We would have been in a depression again if they didn't do that. So I give them a lot of credit. But how low can you go? How low can you move that bar? You move interest rates to zero, and then what? Well, they've done some very interesting things since then, and their intent is to push not only short-term rates, which they control directly, down as low as possible, but also long-term interest rates they want to push down as much as possible as an incentive to get the economy going a little bit stronger. And so, in effect, what they want to do is they want to make you feel rich by inflating the value of your assets. And if you feel rich, the thinking goes, maybe you'll spend a little more money. Maybe you'll kind of start cycling money through the economy instead of holding it under the mattress. And that would be very good for the economy. Is it working? We'll come to that in a minute. But let's face it, the Fed, although it's chartered by Congress to pay attention to unemployment, it really doesn't have the toolkit to directly address unemployment. Only Congress does. So that's why they're doing what they can do. And what they can do doesn't directly affect the problem. That's also different this time from what it was in the past. But here's the effect of what happens when the Fed is actively entering the securities markets. What they are doing is two things. At the short end of the yield curve, in other words, over here, this is a yield curve graph if you haven't seen it, by the way. What it shows you is from 1 month to 1 year to 3 years, out to 30 years. These are maturities of Treasury securities, okay? And going up the side is just the interest rate that is available right now today. So if you want to, the purple line here is what's actually happening. So if you buy a 10-year note today, you're going to be getting about 1.9% interest on that. If you buy a 30-year note, at the other end of the curve there, it's about 3.2%, give or take, interest rate. And of course, at the far short end of the curve, money is free. You get nothing for it. If you think about all of the issues that I've talked about, the growth in the economy, the unemployment rate, the inflation rate, and so on, and you go back and you look through history, When did those conditions pertain in the past? Typically, there is a relationship between interest rates and economic growth and inflation. That's not surprising. And what that relationship is typically the 10-year Treasury trades at about 2 percentage points higher than the inflation rate. It varies, but doesn't mean that's pretty close. So what I've graphed here is our best guess of what the yield curve should look like if it were a completely open and free market and if the Fed were doing nothing. And so you can think about the distance between these two lines as the impact of the Federal Reserve's actions. What they've done is they've pushed interest rates lower everywhere, across the board, and that makes it easier to borrow money, it makes it easier to invest, and it means that you're going to feel a little richer. Is it working? This is corporate America here. The red line shows you the balance sheet of corporate America. It's simply looking at how much debt do they have relative to the size of their balance sheet. And as you can see, companies have been paying off debt like crazy. So their balance sheets are in great shape. The green line shows you their cash flows. All I'm showing you here is their essentially profits before their interest expense, and it's through the roof. So corporate America is really, really healthy right now. Probably even healthier as a section of the economy than you and I are as individuals. That is all very good. Maybe that means they start feeling more confident in hiring and in investing and building new plants and so on, if they feel that we, as consumers, are ready to buy more stuff. That's an interesting question. So where do we go from here? I think you're going to see the Fed holding pretty much the same course for a while. They're going to keep the short end of the yield curve from basically 1 month to about 7 to 10 years as close to where it is right now as they can. Zero at the short end. Money's going to be free for a while if it's short term. Maybe around 2% of the 7 to 10 year mark. Why? Because that's the period where people are buying cars. If you have an adjustable mortgage, it counts essentially as a 7-year or 5-year loan. If you're looking at investing in new facilities, all of those are basically short-term loans. And all of that, the Fed wants to make it easy for you to borrow so that you can then start cycling the money through the economy and get people to spend. At the long end, namely 10 years to 30 years, not so much. That's just about feeling rich. And as the economy begins to gather its own momentum, there's less need for the Fed to be helping you to feel rich, because guess what? You're actually going to be creating real wealth the old-fashioned way, by earning it and by making things happen. And so you're going to see over time the Fed is going to stop or slow down its asset purchases, and as a result, long-term interest rates are going to go up a little bit. How much? How soon? That's the biggest question. And everybody's asking it, and nobody has a great answer. My best guess is sometime later this year, probably toward the end of the year, you're going to see the Fed start to change its behavior. Here's why. The economy is looking better. This is an index of 12 leading indicators. These are economic data that the government tracks and that they compile together as an index. If it's a positive number, the vertical line going up, it means that 6 to 9 months from now the economy is expected to do better. And if it's a negative one, the economy is expected to do worse. So there was a period late last year when it was unclear that the economy was still doing better. There was a lot of concern that we're running out of gas. When you had the hurricane and then you had a fiscal cliff fight, it was unclear that the government was going to act in such a way as to help the private sector get through it. Well, that seems to have dissipated. We've gotten through the hurricane. We've gotten through all sorts of other stuff. The tax picture is better understood. There's a lot less uncertainty now in regulatory and economic policy. And as a result, you can look at the right edge and you can see that, in fact, it is getting somewhat better. And people are feeling more confident. So, do we just go back to the old rules? Or are things still different enough that we have to think differently? Well, let's go back and just take a look at where we are. If you've been paying attention and if you've had money invested, I don't care if it's bonds or stocks or whatever, last year was an amazing year. And the first portion of the first 4 months of this year, if you were in the stock market, even better. You're doing great, right? Equities, stock market is at an all-time high. Not adjusted for inflation, by the way, but in nominal dollars, it's an all-time high. And not only that, it's gotten there in a very orderly way. We look at these things. We think about as an investor, we think about the patterns of trading to get a sense of, is this an orderly advance, one that's sustainable? Is this a panic buying thing like in 1999? Or is it something that has legs? And here, it's got legs. And values, which I'm going to come to, are pretty reasonable. Bond markets, on the other hand, have basically gone nowhere this year, all in all. And that's because they started from being at record low interest rates, record high prices. When you're at a 700-year high price, it's hard to push the price a lot higher. Everything else, by the way, has been so-so. Hedge funds, not really doing much for you. Real estate's been good. There's a lot of interest rate risk in real estate right now. If you're in other alternatives, private equity, venture capital, commodities, oil, mostly you've been very unhappy this year. Stock market's been the exception, and it's been great. But let me talk about where do you go? And again, think about this in terms of, do the old rules apply? What I've been, I think I jumped one, okay. What I want to talk about here is, what do you do in this environment? What we've seen is that investors, by and large, have chased after current income, after yield, wherever they could find it. Because, hey, let's face it, anybody who's living on a fixed income, you're living on payments from your IRA or your 401k or your pension or whatever else, as the dividend yield, as the bond interest rates go down, you need to supplement your income. A lot of people have done a lot of interesting things to do that. Mostly they take more risk, because more risk equals more yield, more current income. And there's a lot of ways you can do that. Think about different kinds of risk that are out there in the world. They're not all the same. There's credit risk. That's simply, what is the risk of a downgrade or a default? It's a lot higher if you're, let's say, a BA-rated bond than if you're a AAA bond. Let's think about duration or time risk. If you have a 30-year bond versus if you have a 1-month T-bill, there's a huge impact that's going to occur regarding changes in interest rates, changes in liquidity and prepayment. All of these are things that we think about and spend a lot of time understanding risk, because that's how you can invest wisely to get a little extra current income without taking too much risk. I'm going to spend 2 minutes on 2 different kinds of risk that people are taking a lot. The first, which I call stupid bond trick number 1, and we put out a paper recently with about a half dozen different things that people do that frankly don't make sense right now. The first is, think about credit risk. Again, this is the risk of downgrade or of default. What I've put up here is a chart showing the risk for municipals in blue and corporate bonds in red over a 10-year period of significant defaults in a portfolio of bonds at different ratings. On the left, you've got 4 investment grades from AAA to BBB, and you see that there's basically no risk. Over 10 years, it's really irrelevant. So if you can take your bond portfolio from AAA to BBB, you are going to pick up a little extra yield, so you get a slightly better interest rate, but you're not really taking on more risk. That makes sense. When you go, this is the high yield or junk bond world over here. When you go from a BA or a BB rating to a CCC rating, yeah, you're still in junk bonds, but boy, are you taking a big risk. It is huge how important that is. Many people miss that. They're buying like crazy some junk bond funds that are concentrated here, and that in the short term may give them better interest rates, but in the long term, they're going to be very unhappy. Here's another kind of risk that you have to think about and manage wisely, and this is simply duration or interest rate risk. And what I'm showing you here is, think about what happens if interest rates, the overall level of interest rates in the economy, rises or falls by 1 percentage point. Remember, we're at a 700-year low in interest rates now. So if interest rates go up by 1 percentage point, then your 2-year note loses $20, big deal. Your 10-year note loses $90. You can live with that, you're not thrilled. But frankly, if you're only earning 2% interest on that 10-year note, and you've just lost 9%, you've basically lost 4.5 years worth of interest because interest rates went up 1%. Now look what happens if you change it to 2 percentage points, 200 basis points, or 2 percentage points which is where we think interest rates would be absent any Federal Reserve intervention. Remember the other chart I showed you that says for this economy, rates really ought to be about 2 percentage points higher. Now, if you own a 30-year bond and interest rates go up to where they should be, all else being equal, you've lost 30% of the value of that bond. You'll never get that in interest coupons, never. So it is important to think about when you're buying bonds, which ones you're buying and how much interest rate risk you're willing to take to get your yield from basically nothing to 2% to 3%, because the risk isn't worth it most generally. There's also a few things that are guaranteed by the rules of math to lose you money. One is if you are buying TIPS, Treasury Inflation Protected Securities. Right now, you would always expect the yield on one of these bonds to be the inflation rate plus something else. But right now, TIPS are trading at lower than the inflation rate, which means if you buy one, you are guaranteeing for the life of that bond that you will lose money relative to inflation. It's a mathematical certainty. So should you invest in TIPS? You figure it out. What about convertible bonds? A lot of people are looking at them and saying, you know, some converts are paying 4% yield. Well, sure, but think about who is issuing them. Anybody, any company with a good balance sheet and a 4% dividend on its convertible is going to convert it to equity because it pays them to do so. And so what you think is a 4% going out to infinity security is actually a 4% for the next few weeks until they get their investment bankers to figure out how to convert it. That's no good deal. And if you're a company now issuing a convert, it's a great deal because you're issuing a bond with a 1% coupon and the promise to convert it into equity at their option at some point in the future. Well, if they're paying 1%, they're never going to convert it because that's cheap, right? I mean, if you can lock in permanent 1% financing, you're crazy not to. So that doesn't make sense either. So again, think about what you're doing when you invest in the bond market, because when you're at a 700-year high, you have to think differently. It is different this time, and the old rules don't apply. So what do you do? Here are some ideas of things that we think make sense right now. The stock market is still one of them, and I know it's at a record high, and I know you're supposed to buy low and sell high, and I'm going to explain to you that equities actually are not, well, they're not really cheap, but they're not expensive either. We think there are some things you can do internationally. We think that there are some bonds that make a lot of sense. We think that there are some other things you can do. So-called bullet bond funds will work when rates go up. Until then, it's interesting, but it's not much. But we can talk about that later if you want. And there are some other options as well that sort of make sense. Let's start with the stock market. This is a chart showing you very simply the dividend yield in blue of the S&P 500 index. That line, if you can't see it, is 5% yield. What it's saying is that, you know, more or less stocks have traded for between 2 and 5% dividend yield since forever. The red line is the 10-year Treasury note, which I told you earlier is trading at about 1.9% interest rate. Now, if you think about stocks versus bonds, it makes sense that stocks should have lower dividend yields than bonds do in terms of their interest rate, because with a stock, the dividend is going to go up over time if it's a good company, and that way you have some growth in the dividend, you have some inflation protection, and you have the possibility that the stock price itself goes up. In a bond, you get your interest coupon, and that's it. And you get your money back at the end if the company hasn't gone under. And so, as a result, bonds have always had higher rates, interest rates, than stocks have. Always since 1958, that is. Now, the Treasury market is again at 1.9%, and the S&P 500 is at 2.1% dividend yield. So not only do stocks give you better inflation protection, not only do they give you better growth, not only do they take care of you by having the possibility of price appreciation, on top of that, you're getting more money right now. That's a good thing. And they're not expensive. What this chart is showing you is a fairly simple looking at price in green and earnings in red. And when you buy a share of stock, what you're basically buying is a claim on the company's earnings. So we can think about stock prices in terms of a price to earnings or PE ratio. I'm sure many of you are familiar with that. it's a measure. There's nothing magical about it. There's no magic number that it should or shouldn't be. But it's a pretty cheap and easy proxy to figure out. And the reason I juxtapose these two lines like this is to demonstrate that now you see that the difference between the two, very conceptually, this is not high-tech stuff, is pretty close. In 2000, big gap. 2007. In 1999, look at that. For the same price, roughly speaking, 1,500 to 1,600 on the S&P 500, for the same price of the stock market, today you're getting $120 of earnings. In 2007, you were getting about $100 of earnings. In 1999, you were getting about $60 of earnings. So you're getting, for the same price, you're getting a lot more value now in the stock market than you have any time the market has been anywhere close to here. So yeah, things change over time. Interest rates are going to go up eventually, I guarantee it. And stock market multiples may come down a little bit, but the companies are earning, and you've got better earning protection now than you have before. Let me spend a minute on sector rotation, the notion that within the stock market you can do different things at different times. What I'm showing you here is these are the 10 standard definitions or sectors of the economy that Standard & Poor's tracks. And this is simply how well each of them has done over the course of this year. And what you're looking at is the best stocks to be in this year: utilities, healthcare, consumer staples, that's things like CVS and Walgreens and so on, Kellogg's, Coke, and telephone companies. The stuff that hasn't done well, industrials, energy, technology, materials, these are cyclical or growth related. The ones that have done really well are essentially defensive. They're not growing much. I mean, how often do you need a new phone line? How often do you need to get to have significant change in your spending at Walgreens? Not much. It is extremely unusual that a market advance, a rally in the stock market, is fueled by companies that are doing nothing, and that the laggards are the ones who are supposedly growing the best. Well, what does this tell you? What it tells you is that people aren't buying stocks because they believe in growth. People are buying stocks because they can't find current income anywhere else, and they're buying dividends, basically. That's unusual. And what it tells me is that, fine, as long as the economy is not doing anything, if you want to get some current income through dividends, that's okay. I've already showed you that the earnings and the balance sheet of corporate America will support that. But what I'm telling you here is something else also, which is that when, not if, but when the U.S. economy really kicks into another gear, these companies, the industrial companies, the technology companies, the ones that are dynamic, the biotechs and all that kind of stuff, they are the ones that are going to lead the economy forward. And when they do, these companies down here are the ones that are going to provide the next upward leg to the stock market. While those guys who have done very well by you so far this year, they're not going to hurt you, but they're not really going to do much. They've done their thing. So think of that as rotating through sectors, and that's where I think the next leg of the stock market is going to come from. When it's going to come? This year sometime, I think. It may be a very dull summer. It may be a bumpy summer. Who knows? But I'm not trying to make short-term market predictions. What I'm suggesting is that over the course of a business cycle, over a multi-year period, where are we going? And I think the answer is we're looking at better returns through the stock market and in specific areas. Very quickly, there are other areas beyond the United States where sometimes it makes a lot of sense to invest. Right now, the U.S. is one of the strongest economies in the world. The dollar is doing quite well. There's no currency problem right now. There's no inflation problem right now. There's no real reason that you should be jumping out of the U.S. But there are times when it is, and I think when interest rates start going up here, that might be one of them. When you start seeing Europe untangling itself from its own debt problems, and when you see the Far East really picking up its growth rate, you can latch onto that as a nice diversification move. Likewise, on the fixed income side, this is a chart showing how much it cost the Spanish government to borrow. And you can see that the Spanish government last July had to pay 7.5% to borrow 10-year money. Remember, the U.S. government pays 2% for 10-year money. In the last several months, investors have figured out that Spain is not going broke, and as a result, even though they are in a deep recession, it is now costing less than 5% for Spanish 10-year money. You can look at Greece, you can look at Italy and Portugal and see very similar trends. Investors are figuring out that Europe is not going under and that it'll take time. It's still not the value, it's still not the credit quality that the United States is, but there are times when you can buy international foreign debt and make money with it. China is another example. The chart is hard to read, I apologize. It just shows for each month what China's gross domestic product is in growth rate. Over here, they're growing it at 7.5%, almost 8%, and that is seen as a slowdown. And because it's been slowing down, investors have been running away, and so the Chinese stock market is now one of the cheapest in the world in terms of a PE multiple, if you will. And yet, hey, come on, if we were growing 7.5% in this country, we'd be through the roof. We're growing 2% here. So there's value in China, and there are value all over the world in China's region, all over that part of Asia and Oceania and so on. There's value there to be looking for. And finally, in fixed income, you can look at maybe not the longest term, where I think there's a lot of interest rate, but under 10-year maturities, there are places where you can look. High yield is actually quite interesting, despite the fact that it's had quite a run. If you're buying high yield, make sure it's high quality, in other words, BAA or BA rated, the top end of that, and make sure that it's relatively short in terms of its average length to maturity, so that you're not taking too much credit risk and you're not taking too much interest rate risk. But if you control for that, high yield looks pretty good. You can do that as a laddered approach, which most of our account officers have been talking to you about, in which you have a series of bonds coming due in any given year, so that your reinvestment risk when you put that money back to work is not high in any individual year. Munis actually still look good, by the way. That's because most investors are worried about state and local budgets. We think we're okay there, because as tax revenues pick up with a growing economy, they'll be able to pay their bills. So munis are a very interesting area right now. And bullet bonds, which have defined maturities, unlike standard bond funds, also give you some advantages that, as rates begin to go up, might be very appealing. So I'm going to close here. I'm going to show you just a couple of last pictures that discuss how, and think of this as the commercial part, okay? This is the way we think about investing, not just in the scenario, not just in the environment I've just described to you, but also across any investment world. What are we thinking? Right now, the economy is mixed, but basically pretty positive. Right now, stocks look good. Right now, fixed income debt looks expensive. We all understand that. I've gone through that. And I think that we should be looking in other places as well as the U.S. gets more expensive. Here's where you have to think about it. It's about risk. It's not about returns, okay? We don't get paid to chase performance. Other firms operate differently, and that is what they want, and that's their priority. But for my perspective, if you want to earn good returns, the way to do that is to manage the risk. You don't run away from risk. You're not all in cash. You don't embrace risk. You're not all taking the 30-year bond because it's got the highest interest rate. What you're doing is managing and controlling and thinking about all these different kinds of risk that are out there. And if you manage them properly, if you select investments to target the kinds of risks that you think are valued well in the market and avoid the ones that you think are valued improperly in the market, then you're in good shape. And remember also that your return is going to come from many different places. It's not just price appreciation. There are other ways that you earn a return on that risk. So doing so, remember also, money is just a tool. It has no real life of its own. There's no soul or anything like that. Money is a tool. It helps you do things. So what do you want to do with your money? What is your goal? Think about all of these issues. I just listed a few that I could think of off the top of my head, and your chart may look very different. How much of your assets, of your wealth, do you want to live on today? How much do you want to put aside for tomorrow, and is that for your kids' college, or is it for the vacation home, or for leaving a bequest to your favorite charity? That's your business, not mine. But how you invest is determined by this. because each of those different goals has different cash flow characteristics, different time horizon, different frequency, different liquidity, different risk profile. And so when you think about all of those issues, you're going to come to understand what the right investment posture is. And of course, I got to tell you that our account advisors, and there's a bunch of them in the room here, understand how to do this really well. Obviously, you believe that or you wouldn't be here. And think also about this. When you invest, remember you own a home, perhaps, perhaps not. If you do, you have equity in that. That's a very important financial asset. If you're still working, or if you have other financial assets, your income stream in the future is a financial asset that you have to think about. And I see a lot of people who have making a very good current income, and they put all their money into their own company stock. Well, that's a double risk, actually, because if your company has problems, you lose both your job and the value of your portfolio. That hurts. So think about balance and think about your investments in the context of everything else in your life. And I think you're going to wind up a lot happier. So let me stop there. I'll just leave my numbers up there for as long as you need them. I have the slides in full page format if you want them. Just let one of our advisors know. I'll email them to you and so on. And I'll take as many questions as you guys have time and interest for. Yes?
I have a question. I want you to criticize this. I base the U.S. economy on the price of platinum versus gold. Up to a few years ago, gold was much higher than platinum. This year, I see platinum rising above gold. Now, gold has limited commercial use, while platinum has tremendous use. It's a catalyst to most of them react. Now, what's wrong? And because the price of platinum is exceeding gold, I feel the U.S. economy is getting stronger. Would you please criticize my thinking?
Did everybody hear that? The basic thesis here, which I will tell you up front, I have not heard before, so you get one gold star for creativity, is that the price of platinum is often determined mostly by industrial usage. There's a real value to how it's used in various things. The price of gold, which used to have industrial uses in jewelry and electronics and so on, is increasingly basically just a speculative investment game. So the theory here is that if platinum prices are going up and gold prices are going down, it means that there's real demand for industrial stuff. And if the reverse is happening, then we're really in a financial excess. I can't disagree with you, actually. The price of gold is going down right now because the industrial demand isn't enough to sustain it. There's only so much jewelry and electronics being made. Gold as a metal has no inherent value. It doesn't produce cash flow. It doesn't pay you a dividend. There's no actual value to gold in an investment sense. So it is purely a measure of people's emotions. And when people buy gold, they're saying that either inflation is going through the roof, or the US dollar is going to be devalued against other currencies, or oil prices are going through the roof, or something else like that. None of that applies right now. Right now, the economy is getting stronger. You're absolutely right. And there's really no reason to be fearful about the kinds of things that people typically buy gold for. So, you know, I haven't really thought through, is there a lot of economic data behind what you're saying, or does history support that notion? But right now, I'd say you're on the right track. Any other questions? Yeah, in the back.
Michael, how about preferreds?
I think preferreds are an interesting case, and it depends very much on whether it's a new one or an old one. Because new ones, again, are being issued with very low coupons, and that makes them somewhat less attractive. It depends also on whether there are voting rights attached to them, whether they convert to common equity, or whether they are just out there forever as essentially a preferred. But to the degree that you can get a better coupon on it, and it's a solid company where you believe in the equity, and the bonds underneath the preferred are not going to be downgraded, I have no problem owning preferreds.
Yeah. You touched very briefly on munis. Could you expand a little bit more on what's going on, what you think will be going on in the future with bonds and munis?
Sure. The question is about municipal bonds. And can I just kind of elaborate on that a bit? Here's what I think about munis. Historically, they have traded at a discount yield to treasuries. And that makes sense because historically people figured the federal government is certainly money good, and the state governments and local cities and towns are pretty much also money good. They're supported by rising tax revenues from rising real estate values mostly. And so when you adjust for taxes, you figure that if hypothetically you've got a 6% federal bond and you've got that's going to be taxed, let's say, at about a 33% rate. So it's really after tax giving you 4%. If you then look at a muni, which is equally money good, then after tax that ought to also yield about 4%. But since it's not taxable, that means the gross yield is also theoretically around 4%. That's why historically there's been a discount that you get buying a yield on a muni versus on a treasury. And it's why if you are a tax-exempt investor, a charity or a government or something else, you never went to munis. It made no sense. This is different. Right now, munis are trading at premium yields to treasuries. So when you're looking at a treasury yield of 2%, not 6, but 2%, then you can see, you can buy munis for a better yield than that, typically somewhere in the high 2s, typically for the same maturity. And that looks better because you still get the tax advantage as a taxable investor. And the bet you're making is that the credit quality of the specific towns or states that you're buying is good enough that those bonds will be money good. And the fear that many investors have is that it isn't, because you see all the press about Illinois and California and some towns here that are having trouble, whether it's because their snow budget went over or because of various other things, or their pension obligations are killing them, or because the town of Stockton, California and Vallejo, California actually went bankrupt. So there's fear in the muni market. But the reality is that the vast majority of them are quite good credits. They're not going out of business. They're not going to default. And so you can actually pick up pretty good yield on munis relative to treasuries for, if not exactly the same safety, pretty close. So we like that market. Yes? I'm sorry, can you speak a little louder? The question is, Spain has 27% unemployment. It's not counted exactly the way we count it, so it's always going to be higher than the US number. But 27% is kind of ridiculously high anyway. And given all of Spain's problems, why should they bother staying in the euro? Shouldn't they simply devalue their currency and create some growth? I'm putting a few words in your mouth, but that's essentially... I'm sorry? Yeah. So is that a good idea? Frankly, the benefit of staying in the euro is that Spain's borrowing cost is lower in the euro than out of the euro, because to some degree, staying part of the eurozone protects Spain's economy and protects investors who are traveling in and through Spain and who are investing in euro area securities. So I think that if they were to leave the euro, it would be so disruptive, it would crush the currency, and it would therefore make everything that Spaniards buy much more expensive, which would really hurt their economy. Instead, what makes a lot more sense is for the European Central Bank to recognize, as they finally have, that austerity is not helping matters, it's making matters worse. Because when governments are pulling back and shrinking their spending, it is a drag on the economy. Same is true here, of course, as I showed you in one of the very first slides. But when you think about it in the case of Spain or Greece or Portugal or any of those, what you're really saying is that if those governments have a somewhat looser hand with money, then they are able to start investing and creating the programs that will reduce unemployment. You can't mint money if you're in the euro. Only the Euro Central Bank can do so. That's the downfall. But if you were out of the euro and you just printed enough money to kind of, spur all of that, the currency would collapse, as happened in Iceland. You can look at that as an example of what happened that shouldn't be done. Okay, I think that's as many questions as people have for right now. As I said, oh, one more in the back. Yeah.
What do you think the life is for this bull market?
The question is, what do I think the life is for this bull market? Very good question. I think that as long as the yield on, and again, the value of a stock price is related to the value of interest rates. It's one of the fundamental underpinnings to stock prices. So as long as dividend yields are higher than interest rates, stocks are going to keep going up. When the Fed starts to tighten up, when it stops buying long-term assets, interest rates at the long end are going to start creeping up. People are going to freak out. Some of them are going to say this is terrible and they're going to sell, and there'll be some churn in the market. But others are going to say, why is the Fed tightening up? Must be because they think the economy is good. And typically speaking, when interest rates start to rise, until the 10-year Treasury gets to about 6% or so, stock prices go up. One very good example was the period from 2002 to 2005. Another was when Bill Clinton first came in 1993 or so, the first couple of years there, when when interest rates go up from very low levels to around 6, it's good for stock prices. So I think that given how long we expect interest rates to stay very low, the stock market has quite a ways still to run. Oh, yes?
How much concern, if any, is the national debt in the United States, which is now approaching, I think, $17 trillion?
How much concern is the national debt? I don't think of it in terms of absolute number of dollars of debt. The way I'm going to think about it and respond to the question is how expensive and difficult is it for the federal government, the Treasury, to pay interest on the debt and to service the debt. When interest rates are very low, it means you and I aren't earning money on our savings bonds or our treasuries or whatever else. But it also means that the Treasury isn't spending much money to service the debt, right? It's the same as when I refinance my house. Well, the Fed is basically refinancing itself every month that it issues debt. So as long as interest rates are low, the absolute level of debt kind of doesn't matter. They've got plenty of liquidity. They're able to finance it easily. Right now, the Fed is actually, the federal government, Treasury, is reducing the national debt because receipts are higher than spending. Partly because spending is down, and partly because this is May, and the federal government just got a whole lot of April 15th tax returns with checks attached. So that may or may not last. But as long as rates remain pretty low, it's easy for the Treasury to service the debt. When rates start going up and it starts becoming more expensive for the federal government to pay its bills and its debt service, that's when the national debt really becomes bothersome. And that's why it is not an urgent panic issue to reduce the debt right now, no matter what people in Congress will say. But it is an important issue over time to reduce the debt, no matter what other people in Congress say. So it's a question of degree and timing to reduce the debt gradually while rates are low, so that when rates go up, it's no longer a burdensome number. Okay, thank you very much for coming. I really appreciate it. And